We want to bring in Macromavens President Stephanie Pomboy right now as we get the retail sales number and the PPI. The expectations are PPI down 0.1%, down 0.1% on retail sales. That was worse than expected. We were expecting a gain of 0.3%. Retail sales are down 0.1%, and the PPI right now is up 0.2%. Versus an estimate of 0.1%. So this, too, is worse than expected. Two numbers worse than expected. Stephanie Pomboy, good to see you.
Okay.
Reaction?
I guess, this is the worst possible combination. We're really looking for retail sales to go up, obviously, on this first month impact of the tax cut. People got bigger paychecks this month. Plus, we've had pent-up, quote-unquote, consumer demand because we've had punk retail sales numbers for basically 3 months. If you look at retail sales through January, we had no growth, excluding food and energy. So the growth we were seeing was all non-discretionary. Now we should have really seen a really sizable increase this month as all these, tailwinds gave support. The fact that we didn't is incredibly disappointing. It does suggest that consumers may really save this tax cut rather than spend it, which is exactly what they did with the Recovery Relief Act following the crisis. We all kind of fastened our seatbelts waiting for that huge increase in consumer spending, and it never materialized. And I think this gets back to the whole topic we've talked about so much here, and that is that beneath the surface, consumers are really stretched. And, there's not a widespread appreciation of that fact because people look at the headline spending numbers and they fail to take out how much of that's being driven by non-discretionary items. Like, they're not buying by choice. They're buying because they have to.
By the way, this is the third month in a row of declines on retail sales.
Amazing.
Wow.
Amazing. So they must have revised down December because that was unchanged. And then January was weaker. So this is really, this is a major warning shot for Wall Street because the entire earnings projection forecast for this year, that 18-20% earnings growth is in part the tax cut math, but also the presumption that consumers are going to spend this tax cut. If they don't,
one thing that you've been pointing out, one reason you see this pullback in retail sales is debt service. What the impact, Americans are already feeling the impact of rising interest rates. 30-year mortgage at a 4-year high. Right. But again, paying more to just service those credit cards.
And what's interesting is there's been a lot written about LIBOR, which has moved up sharply in the last few months. And adjustable rate mortgages, basically, there's $350 trillion that's tied to LIBOR, but adjustable rate mortgages have moved in lockstep. So the debt servicing is kind of that silent issue that's behind the scenes that people, again, aren't acknowledging because there's a sense that the consumer is doing just fine. In reality, they've ramped up borrowing and they've rated whatever saving they had amassed post-crisis to stay afloat.
Markets are not reacting to any inflation. PPI was up 0.2%, expected to be up 0.1%. Markets are exactly where they were. In fact, we're actually trading up from where we were.
This is in your wheelhouse. We should point out, ex-autos sales were up 0.2%. And then excluding cars and gasoline, sales up 0.3%. So if the market isn't worried about a slowing economy, maybe that's the underlying
It's still weaker, though, because I think ex-autos, it was supposed to be up 0.4, so it's half of the expectation. Plus, this combination is really bad because the CPI at 2.2 is running now. I guess this number, if it was up 0.1%, PPI was supposed to be at 2.8. So you're looking at a difference between the CPI and the PPI where basically this is a proxy for profit margins. It's a crude proxy. But if input prices are going up faster than the ability to pass them on, that's a problem for companies. And right now you have the CPI running at least half a percentage point below input price.
So in business, when that happens, you got two alternatives: to get price if you have pricing authority, and a lot of times you don't.
Right.
Or your margins get hit. And that's going to have an impact on the projections going forward because, you look at the Business Roundtable and the recent thing that Jamie Dimon's projected, that every business was very strong. But I think you got consumers now taking advantage, catching their breath to get, out of the ditch and get their head above water. You've been talking a lot about getting out of stocks and getting into gold and bond. You still believe that?
I do. I mean, I think that in the 9th year of this bull run, and we've talked about the increase in market cap relative to the growth we've seen in the real economy. I mean, it's no secret that the Fed's massive monetary stimulus really flowed to financial assets and largely bypassed the economy. Yeah. And the feeling now is that even though we took asset prices to extremes relative to the economy, that's all going to close by growth picking up. We're challenging that assumption with these retail sales numbers.
But can I play devil's advocate a little bit? We have seen a lot of workers come off the sidelines back into full-time work. We have seen wage increases in some of the less skilled areas, so it's starting at the bottom. That's going to eventually move up as more and more people get into the workforce. Companies have to compete for them. And look, this is just the first month after the tax cut happened. So, have we given consumers time to fully price in the benefits of what they're going to realize through that tax cut?
Yesterday, Chuck Schwab said this is a long runway, and the tax plan is not going to have an impact immediately the way that it's going to have an impact over the long term.
Yeah, those are good points, all. And, I would say that big increase in payrolls that we saw in February was all the more reason to expect retail sales would have been better today. Yep. I'm sorry, did I say the big increase in payrolls should have?
Yeah, right.
There are reasons to suspect that maybe consumers might be inclined to save this money. But the other point on the employment front, which we talked about on payrolls, is that all the growth in employment has been in people 55 and older. So we have a dynamic here where you're not really freeing up jobs for younger workers. There's actually employment in people 55 and younger is down from where it was at the peak of the crisis. So we're not really creating the jobs necessary.
So how do you explain this market? How does this market continue to go up?
Well, I think it's what you articulated, which is 1 month doesn't a trend make. Let's give this a chance. There is a long runway. People have to get acclimated and believe that this, increase in their paychecks is real and sustainable, and that they're not also going to get walloped with higher prices.
No, but it's about corporate earnings. Come on. A tax rate going from almost 40% to 21% is a huge deal, and that's why we're seeing expectations of S&P 500 earnings this year being up 18 to 20%.
Right. And, what I come back to is what's going to happen in 2019. So we have a boost mathematically from the tax cut in 2018, but the market is resting on the assumption that that's going to kick into real, genuine economic growth that's sustainable. They're going to increase capex and hiring, and consumers are going to go out and say, I feel better, I'm going to spend more. And that is what we're looking at now.